Real estate basis is rarely just the price on the contract. For purchased property, your starting point is cost. Then you add certain acquisition costs that are part of getting the deal done. On the EA exam, they'll test whether a payment is really part of buying the property or something currently deductible. If it's tied to acquiring the property, think add to basis. Closing costs are the classic basis add-ons. Think recording fees, legal fees for the purchase, title-related costs, and similar charges that are necessary to acquire the property. The exam trick is separating buying costs from owning costs. Owning costs like utilities or routine maintenance are not basis, but costs that get you clear ownership usually are. Now the weird but testable one: delinquent real estate taxes paid by the buyer. If the seller was behind and you agree to pay those back taxes as a condition of the sale, you can't deduct them. They weren't your legal responsibility. So the IRS treats that payment like part of what you paid to acquire the property. Result: add the delinquent taxes to basis. Use the simple math the exam loves. Purchase price plus delinquent taxes you paid equals your basis. Example: home costs $125,000. You also pay $3,500 of the seller's past due property taxes. Your basis becomes $128,500. The key reasoning isn't the arithmetic, it's the rule. No deduction for someone else's tax bill, so it becomes basis instead. Construct property instead of buying it. Basis is basically everything it took to build it. Contractor payments, materials, permits, and inspection fees are capitalized into the building's basis. On the EA exam, watch for costs that feel small, like inspection fees. They still get capitalized because they're part of construction, not a current deduction. Land prep is the other trap. Demolition costs and site prep costs, like clearing stumps or removing an old foundation, go to the basis of the land, not the building you'll put there later. That matters because land isn't depreciable. So if you incorrectly stick those costs into the building, you'd be depreciating something the IRS treats as land cost. Run the numbers. You buy an empty lot for $50,000. You pay $2,800 to remove stumps and $6,700 to demolish an old concrete foundation. Those are land preparation costs, so they increase land basis. Land basis is $59,500. On exam questions, if you see demolition or clearing, your default should be add to land, not building. Which of the following items does not decrease an asset's basis? The choices include the cost of defending a title to the property, Section 179 deductions, a casualty loss, and a manufacturer's rebate. Think about which one is actually a capital cost instead of a basis reduction. Think about it. The correct answer is the cost of defending a title to the property. That's a capital expenditure that generally increases basis because it helps you perfect or protect ownership. A tempting wrong answer is the manufacturer's rebate because it feels like extra money, but rebates reduce what you effectively paid, so they reduce basis. Marisol received 500 shares of restricted stock from her employer on March 1, 2023, but she forfeits it unless she completes 5 years of service. On March 1st, the stock's fair market value was $15,000. How much does she include in income in 2023, and what is her basis in the stock? The options range from including $15,000 now to reporting nothing until vesting. Think about it. The correct answer is that she generally reports no income and has no basis until the stock becomes substantially vested, meaning the risk of forfeiture lapses. That's the IRC Section 83 rule. The tempting wrong answer is including $15,000 now with a $15,000 basis, but that would usually require an 83B election, and the question doesn't mention one.